Hello, and thank you for watching this International Financial Reporting for Non-Profit Organisations webcast on inventory held for use or distribution. This webcast is part of a series that covers some of the key issues in financial reporting that affect non-profit organisations. This presentation focuses on the measurement of inventory that is held for use or distribution. The presentation discusses the initial recognition and measurement of donated inventory, where this is helpful in providing the context for discussions on the subsequent measurement of inventory held for use or distribution. Questions about when donated inventory should be recognised, how it should be measured on recognition, and when to recognise revenue are covered in the presentation on non-exchange revenue. This session begins by looking at the general principles relating to the measurement of inventory. Next, we will consider the main issues that NPOs face when accounting for inventory held for use or distribution. We will then look at how these issues are currently addressed in the existing accounting standards, beginning with the international standards, before looking at how some national standard setters have addressed NPO-specific issues. Finally, we will look at the alternative treatments identified in the consultation paper. NPOs hold a wide variety of inventory. Examples include medical supplies, textbooks, food, clothing, fuel, furniture, equipment, and leaflets. NPOs may hold inventory for commercial purposes, for example, items held for sale in shops to generate revenue to support the work of an NPO. NPOs may also hold inventory to be used directly in meeting their objectives. Such inventory may be held for direct distribution to service users, or may be held for use by an NPO in delivering services. Inventory held for any purpose is generally measured at cost on recognition. For purchased inventory, or inventory the entity produces itself, the cost will generally be known. Where inventory is donated to the entity, measurement on recognition is generally at fair value. The non-exchange revenue presentation discusses this further. After recognition, in accordance with international standards, inventory is generally carried at the lower of cost or selling price of the item less any costs to complete the item, sometimes referred to as its net realizable value. Cost to complete the item typically refers to inventory produced by the entity that is partway through the production process. So net realizable value is the price that would be obtained if the complete item was sold. Where the selling price less any costs to complete the item is lower than the cost of the item, this means that the entity will not be able to recover all its costs, and the inventory is impaired. The carrying amount of the inventory is therefore reduced to its selling price less any costs to complete the item. The amount of the reduction to the carrying value of the inventory is recognized as an expense. For non-profit organizations, a key issue is that NPOs may hold inventory for use in providing services or to be distributed at no charge, and so there are no sale proceeds. For these types of inventory, there is a question about how the impairment should be assessed because there are no sales proceeds. On this slide, we will discuss the issues facing NPOs in more detail. When recognizing inventory that is held for use or distribution, there are no NPO-specific issues if the inventory is purchased or produced by the entity. While there may be challenges for some NPOs in determining the cost of own-produced inventory, these issues are unlikely to be unique to NPOs. If inventory has been donated, an NPO may face difficulties if it is not clear whether the inventory can be used. An example of this are medical supplies that are close to their expiration date being donated to an NPO that provides medical services. If it is not clear whether the inventory can be used before it expires, there may be difficulties in determining whether the donated inventory should be recognized. These issues are discussed in the non-exchange revenue presentation. When donated inventory is recognized, issues may arise with its initial measurement. The absence of a purchase cost means that the entity will need to prepare a reliable estimate of the fair value of items. This would apply to inventory donated for distribution to service users or for an NPO's own use including for administrative purposes. Practical difficulties can arise in determining whether all of the items donated have a value to the NPO, even if the value of each item is known, because of uncertainties over whether the NPO can use the inventory. Trying to assess the fair value of such items may impose costs or administrative burdens on some NPOs. Some NPOs may find it challenging to keep inventory records, particularly if they do not have an inventory control system. The cost of assessing a fair value might be disproportionate to the value of the item and exceed the benefit derived from being able to recognize the items as inventory. Consequently, in some cases, an alternative method of assessing the value of the inventory may be required. After initial measurement, determining subsequent values for some types of inventory may also be challenging, for similar reasons to those we have just discussed. As described on the previous slide, after initial recognition, inventory is subsequently measured to ensure that its carrying value does not exceed the value that can be obtained from the inventory. Determining the value that can be obtained from the inventory where there are no sales proceeds may be challenging, and on the following slides we will see how the various standards address this issue. Also, in the presentation on non-exchange revenue, we discuss the possibility that some donated inventory is not recognized as inventory in the balance sheet. If it hasn't been recognized in the first place, it can't be subsequently measured, so no issues of subsequent measurement will arise. At the beginning of this presentation, we discussed some of the general principles around measuring inventory. In international standards, IFRS and IFRS for SMEs have the same requirements for inventory, and the requirements in IPSAS are also very similar. Under all these standards, inventory purchased or produced by an entity would be initially measured at cost. Donated inventory, where this can be recognized, would be measured at fair value, and this is explicitly stated in IPSAS. In IFRS and IFRS for SMEs, the use of fair value is a result of their general recognition requirements. Unlike the other international standards, IPSAS includes an exception for work in progress of services to be provided for no or nominal consideration. An example would be where an NPO prepares legal casework to support refugees and asylum seekers. Until a case is heard, the casework being developed may be considered inventory if it meets the recognition criteria. Unless record-keeping systems such as timesheets are in place, NPOs may find it difficult to determine the cost of the casework to record it as inventory. Under IPSAS 12, entities determine their accounting policies for such transactions. This would allow an entity to elect not to recognize such items as inventory, but instead recognize an expense as the costs are incurred. This choice could simplify record keeping. All three standards require inventory held for sale to be subsequently measured at the lower of cost or selling price less cost to complete, as previously described in the general principles for measuring inventory. But this does not apply for inventory held for use or distribution. IPSAS 12 includes an alternative approach to subsequent measurement, where inventory held for use or distribution is measured at the lower of cost or current replacement cost. There is no equivalent in IFRS or IFRS for SMEs. Finally, when measuring inventory produced by an entity, cost formulas may need to be used. All three international standards permit the use of the first in, first out, or FIFO, and weighted average cost formulas. We have found that the jurisdictional level guidance and standards can be converged on IFRS, IFRS for SMEs, or IPSAS. They can also be set independently of international standards, but there is consistency on the core principles around accounting for inventory. There are, however, differences about the measurement of inventory held for use or distribution. As well as the points I'm about to discuss, the separate presentation on non-exchange revenue provides additional information about approaches taken by national standard setters to donated inventory. One jurisdiction has a standard based on IFRS standards, IAS2. This national standard does, however, provide an exception for work in progress of services to be provided for no or nominal consideration, and this is the same exception as in IPSAS. Guidance is provided for measuring donated inventory. Inventories held for use or distribution are measured at cost, adjusted, i.e. impaired, when applicable for any loss of service potential. This guidance notes that for many items of inventory, a loss of service potential would be identified and measured based on the existence of a current replacement cost that is lower than the original acquisition cost or other subsequent carrying amount. In other words, there is specific guidance for NPOs that considers where inventory is held for social benefit or service potential rather than for profit. Where inventory is donated, i.e. acquired in a non-exchange transaction, current replacement cost is used as the cost of the inventory. One jurisdiction has a standard based on IFRS for SMEs with some amendments. Guidance is provided for measuring donated inventory. Similar to the guidance based on IFRS standards, the impairment of inventories held for use or distribution takes into account any loss of service potential. However, replacement cost is also considered. One jurisdiction has a standard that is based on IPSAS 12, with guidance provided for measuring donated inventory. Unlike IPSAS 12, inventory held for use or distribution is measured at cost, adjusted, i.e. impaired, when applicable for any loss of service potential. In this respect, it is the same as the national guidance that I mentioned earlier, which is based on IFRS. One jurisdiction has issued a general standard on inventories that is not based on international standards, but is broadly consistent with IFRS standards and IFRS for SMEs. This standard setter has also issued a separate standard on inventories held by non-profit organisations. This standard includes guidance on donated inventories. Inventories held for use or distribution are measured at the lower of cost and current replacement cost. In other words, inventory is impaired where the current replacement cost is lower than the cost of the inventory. Unlike some other approaches, it doesn't take account of service potential. Measuring inventory to reflect its service potential may help NPOs. For example, NPOs that hold short life inventory may be better able to show that service potential reduces as the inventory approaches life expiry. Finally, another jurisdiction has a standard that is not based on international standards, but is again broadly consistent with IFRS standards and IFRS for SMEs. This jurisdiction permits the use of the last in, first out costing formula, albeit with specific impairment provisions. This standard does not provide any specific guidance for NPOs. In considering these issues, three alternatives are being proposed for feedback. Alternative 1 is based on the requirements of IFRS standards and IFRS for SMEs, but with additional guidance for NPOs. No divergence from the requirements of these standards is proposed. The guidance could help NPOs apply general materiality principles and expense items as they are required. Alternative 2 is based on the requirements of IPSAS. This alternative allows work in progress for no or nominal consideration to be expensed. Alternative 2 also provides for inventory for distribution to be valued at the lower of cost and current replacement cost, with additional guidance for NPOs. Alternative 3 is also based on the requirements of IPSAS, as Alternative 2, but requires that inventory for distribution is valued at the lower of cost and current service potential. This valuation technique is not permitted by any current international standards, but is required by one jurisdiction as part of its national standards. As with Alternatives 1 and 2, additional guidance would be provided. We want your views. The more views we receive, the better informed we will be for the next phase of this project. The consultation paper includes a number of specific matters for comment. The specific matters for comment relating to inventory held for use or distribution cover the description of inventory held for use or distribution, whether the list of alternative treatments is exhaustive, and your preferred alternative treatment. Please respond to the consultation paper. The consultation period ends on the 24th of September 2021. Shape the future. Share your voice. Submit your response.